Welcome to the Deep Dive Talk Tickers edition. Today we are plunging into one of the most tense earnings reports of the season. PagerDuty, ticker PD, their Q3 fiscal 26 numbers that dropped after the bell on November 25th.
This quarter was just a brutal lesson, really, in what the market actually cares about.
Right.
And our mission today is to figure out that core tension. How does a company deliver a massive profitability beat and then get completely crushed?
It's all about the guidance cut, that sell-off.
It is. We have to look past the quantity of profit and really start judging the quality of the growth.
Okay, so let's get those headline numbers out on the table right away, because the contrast it's jarring.
Yeah, let's do it.
So the good news first. The profit side was phenomenal. Non-GAAP diluted earnings per share hit 33 cents.
Which just smashed consensus. The street was at what, 25 cents?
Around 25 cents, yeah. So that's a 32% beat. And they also hit GAAP profitability for the second quarter in a row. Net income of $159.6 million.
Okay, but we need to pause on that GAAP number for a second.
Go ahead.
Because it looks amazing, but it's a little misleading if you're trying to understand the actual health of the business this quarter.
So unpack that for us. What's the catch?
The catch is that $150 million of that was a one-time non-cash deferred tax benefit. It wasn't cash from operations.
So they're basically using past losses to offset future taxes.
Exactly. It's an accounting move. A good one for the balance sheet for sure, but it doesn't mean they sold an extra $150 million worth of software. The real story is that non-GAAP beat, and that was driven purely by being disciplined on costs.
Got it. And that cost discipline is what makes the other side of the story so painful.
The top line.
The top line. Revenue came in at $124.5 million. It was a slight miss, but not the disaster.
No, the disaster was the growth rate. Annual recurring revenue, ARR, grew only 3% year over year. 3%.
For a software company, that's basically a stall.
It's a dead stop. And that is the signal the market reacted to. The strong bottom line was just completely overshadowed by that number and, of course, the guidance that came with it.
Let's actually dig into that margin story, though, because management executed on that front perfectly.
Oh, flawlessly. I mean, non-GAAP operating margin expanded to 28.5%. That's up 750 basis points from last year.
And they're saying they can get to 30% long term.
They are. They've really proven they can be a profitable company. It's just the growth part of that profitable growth story is what's missing.
And that profitability is building up their balance sheet. They ended the quarter with, $547 million in cash and investments?
Yep, a very strong position. And it's not just sitting there. They're generating real cash. $20.9 million in free cash flow this quarter. That's almost a 17% margin.
Which gives them flexibility. And it directly funds their $200 million share buyback program.
Right.
So here's my question. Here's the friction. They have $500 million in cash. They're generating free cash flow. They're actively buying back their own stock. So why did the market completely ignore that? Why didn't that buyback provide any kind of floor for the stock?
Because the market believes the foundation is cracking, that the core customer relationship is crumbling faster than any buyback can fix.
And that brings us to the most damaging number in the entire report.
The one that really matters. The dollar-based net retention rate, DBNRR.
It fell off a cliff.
It absolutely collapsed. It dropped to exactly 100%.
100%. Just to be clear, for everyone, what does that mean?
It means for every dollar they're getting from existing customers upgrading or buying more, they're losing $1 from customers downgrading or leaving entirely.
So zero net growth from their entire installed base?
Zero. They are treading water. And management said they expect that pressure to continue.
What was the reason they gave? It can't just be the macro environment.
No, they were very specific. They called it seat-based license compression.
Meaning
their biggest enterprise customers are going through huge reorganizations and layoffs. So when a company cuts 1,000 developers...
They also cut 1,000 PagerDuty seats.
Exactly. Their old pricing model, which was so reliable for so long, is now a huge liability. It's tied directly to customer headcount, and headcount is shrinking in their key accounts.
So how are they fighting that? What's the pivot?
The pivot is to change the entire model. They're trying to accelerate a shift away from just selling seats and toward what they call usage and outcome-aligned pricing.
So tying the price to the value they provide, not the number of people using it.
Precisely. Instead of paying per person, a customer might pay based on how many critical incidents PagerDuty helps them resolve, or how much automation they run on the platform. It insulates them from layoff risk.
That's a smart long-term move.
Yeah.
That requires a complete overhaul of your sales team, right? The go-to-market strategy has to change.
It does. And they admitted that. The new CRO, Todd McNabb, is leading that whole transformation. But training a sales force to sell value instead of seats is, well, it's a near-term drag on sales. It slows things down.
The other part of their strategy seems to be AI. They're really pushing this AI-centric operations cloud narrative.
Yeah, and the AI story is directly connected to that new pricing model.
How so?
Well, they just launched this new AI agent suite. If their AI can automate incident response and diagnosis, the value of the platform goes up exponentially.
I see. So the more value the AI creates, the more they can justify charging for usage and outcomes.
That's the idea. It becomes the central nervous system for a company's tech operations, which makes it stickier.
But in the meantime, are they still signing up new customers? Is there any growth happening at all?
There is, yeah. New customer acquisition is still pretty healthy. Customer spending over $100K a year grew 5%, but it's just not enough.
Not enough to offset the bleeding from the big guys.
Right. The contraction in those massive enterprise accounts is just overwhelming all the new business they're bringing in.
Which brings us to the guidance. The part of the call that delivered the knockout blow.
Oof. Yeah. The Q4 revenue forecast. They guided to between $122 and $124 million.
Which implies, what, 0 to 2% growth?
Basically flat, yeah. And the street was expecting closer to 127. Management called it prudent.
Which is code for, this is going to be rough.
And then, of course, they had to cut the full year outlook. They took the range down from about $495 million to $491 at the midpoint.
And here's that contradiction again. They actually raised the full year EPS guidance.
They did. Raised it to $1.11 to $1.12.
That one data point tells the entire story, doesn't it?
Mm-hmm.
The profit plan is working perfectly, but it's completely disconnected from sales. It's all cost cutting.
100%. And then, to add another layer of risk, the CFO, Howard Wilson, announced he's retiring.
After 9 years, he took them through the IPO.
Yeah. I mean, it's positioned as a planned retirement, but losing your veteran financial leader right in the middle of a massive strategic pivot, the market does not like that kind of uncertainty.
Okay, let's quantify the market's reaction. The stock closed the next day at $11.64.
A drop of 23.3% in a single day.
On huge volume.
Staggering volume. Almost 19 million shares, which is like 9 times normal. This wasn't just a few people getting scared. This was institutional grade de-risking. The growth funds saw the guidance and they just bailed.
And how does PagerDuty look compared to the rest of the software sector? Is this a widespread problem?
It really doesn't seem to be. Their stock is down almost 44% over the last year. The broader software ETF, IGV, is only down about 1%.
So this pain is very specific to them and their pricing model.
It seems to be. The seat compression issue is a PagerDuty problem. And the analysts reacted immediately. We saw downgrades, price target cuts. The consensus is basically hold or neutral now.
Everyone is just waiting to see if this is the bottom.
Exactly. The whole thesis now is this year the trough for growth? And can they get that net retention number back above 100% sometime next year? That's the entire bet.
Okay, let's shift gears. It's time for our segment where we look at the market disconnect. And of course, a full disclaimer, this is not financial advice. Do not act on anything you hear. This is just a thought experiment.
A thought experiment on how extreme reactions can create interesting setups.
All right, so the setup here is a 23% crash on a profitable, cash-rich company with an active buyback.
It's an intriguing disconnect. You have 2 clear facts. Over $500 million in cash on the balance sheet and a $200 million buyback program that's live right now. They have the ammo to defend the stock at these levels.
So what's the outrageous but plausible trade idea here?
It's a paired trade. First, you initiate a long position in the shares themselves, betting that the buyback program puts a hard floor under the stock near these post-earnings lows.
Okay.
At the same time, you look at the options market. We saw a big spike in activity around the December 19th, 2025, 1250 call.
So options traders are already betting on a rebound.
They're speculating on a short-term pop, yeah. So you could leverage that. The rationale is simple. The institution sold the top-line fear. The company itself is actively buying the bottom line reality. You're essentially betting that the company's capital allocation wins out over the market's short-term panic.
That brings us to our wrap-up. Let's distill this down. PagerDuty is successfully becoming a profitable company. That part is working.
No question. The margins are great.
But the cost of that is near zero growth because their old pricing model is getting hammered by enterprise layoffs.
Right. And the whole company is in the middle of a painful, complicated transition to a new model.
So that leaves us with the final provocative thought for you to chew on.
The management team is selling a new story. They're telling everyone PagerDuty is now an indispensable AI-native operations cloud. The question is this: will that new AI narrative and the shift to usage-based pricing be enough to re-accelerate growth before the profitability story, which is mostly just cost-cutting, runs out of steam? Because that cost-cutting has a limit. They have to get the top line moving again.
A huge challenge for them heading into the new year. That has been our deep dive into a very tense earnings call. Thank you for joining us on Talk Tickers, where we cut through the noise so you can be well informed.